Australia's export boom is over. Let's have a look. Good morning everyone, Florian Heise here and welcome to another episode of Heise Says. As always, with my stein of good coffee, I thought we'd go through this article about our apparent export boom and how it's over because it's peaked. Now let's just jump to my favorite website and I will bring this up here. This is the Observatory of Economic Complexity. And I'm going to jump over here so I can actually show you the mouse on it. And you can see, this is for Australia. And this is a great website. You can look up any country and get a whole lot of information just about the country. And it's visualized quite well. So this is all of Australia's exports. 244 billion as of the date that this is prepared. You can see iron ore is a pretty substantial part of our export sector at 20%. Coal, 19%, petroleum gas, 8%, gold, 12%. So it's interesting to compare and contrast what different countries produce, because then from that you can get an understanding of the complexity of the economy. So here's our economic complexity. So we're 59th in the world. Australia's 59th of the world. We are a raw materials producing nation and foodstuffs producing nation. Wine, wool, even some raw aluminium oxide. Where's something advanced? Computers. 244 million. Wow. Broadcasting equipment. 491 million. But then if you have a look at what we import 7.22 billion dollars worth of broadcasting equipment. Cars. We import 18.1 billion. Do we export cars? Oh, we do. 791 billion. Refined petroleum. Crude petroleum we export 3.29 billion. We import refined petroleum 14.4 billion. And we also import 6.75 crude petroleum. So it's good to get an understanding. Then you can go down here and have a look at our trade balance and our destination countries. So this is why I've been talking about this before, that we're very dependent on China with regards to our export sector. And even, remember, this only captures the material exports. It doesn't capture any of the services we provide. And a large number of international students that come to Australia that stimulate and pretty much prop up a lot of our universities financially come from a lot of the Asian countries, which makes a lot of sense. I mean, the weather's awesome in Australia. You get English just as good as America. The education is world class. And the Aussie dollar is a lot cheaper than the US dollar. So, good on you. Take advantage of it, guys. But it just helps you understand that if there's slowdowns in these countries, it flows through to the demand of these things. If our dollar drops, all of this will get more expensive. All of it will get more expensive. And this is where we're importing from. So you can see China, 24%. United States, 10%. Oh, you can't see it because my picture's in the way. There you go, 10%. Germany, 4.6%. So, and you can get even further in these diagrams here about the production space. And, this is a great website. Really useful. It's drawing the visualizations. I love these type of drawings. Just my architectural heritage coming out there. So, we can see that if the mining boom slows down, and we'll go here, mineral products is 131 billion. So if that slows down, I wouldn't be surprised if our peak or our boom is down. I mean, we'll look at one more thing. Let's jump here quickly to another website I love. This is Trading Economics, and you can see just different commodities here, and we'll have a look. Now, if we look here, let's have a look at iron ore. Iron ore. Where is it? Here. Oh, it's gone up to $90. That's good. So it was down at 85. And then we will go at 1 month scale. And you can just see how it's fluctuated recently. 120 down to 90. So 2008, right before the GFC, it was at nearly $200. Wow. Nearly $200. And boom, look at what happened there. Down to $62. My understanding is that the companies pull the stuff out of the ground at $14, $15 a ton. And so they're still, very profitable. But look there how it went down to $43 a ton. So it is dropping, guys. It is dropping. And a lot of this demand for our natural resources is coming from overseas. So that's going to have a bit of an impact on us. That's why. That's really why when, people say, oh, Liberal's the better economic manager, Labour's the better economic manager, how can they possibly hope to actually have any economic impact on our, what these countries are importing? Because we're tiny on the scale of things. The size of our economy is very small. We're not very complicated. We're not an advanced economy, and we're dependent on these resources. All they can do, really, is just piss off our international relations and then damage this. They might influence what's coming and going. And I think that's actually happening at the moment. So, oops. I'll bring that up. Good. Okay, I shut my OneNote. So let's have a look. We'll read through this article. The export boom may have peaked as key commodities roll over. A sudden slump in iron ore prices and shipments may point to Australia's export boom hitting its peak. While the July trade surplus was still a robust $7.9 billion, only bettered by the $8 billion reported in June, the heavy reliance on iron ore to Australia's export effort suggests the recent months' performances may be about as good as it gets in the medium term. A bounce in LNG, plus 5%, and the always volatile gold, plus 66%, exports rescued the surplus from a sharper fall and offset a pickup in imports. Well, gold is at an all-time high on the Australian dollar. And silver, although it's eased off last night, it was doing quite well, I think a 3-year high. So people are seem to be moving to these precious metals for some reason, because everything's good. So, looking ahead, given iron ores are weighting in the aggregate export basket and the recent fall in prices, it seems like June's outcome is likely to be a high water mark for the external sector, JP Morgan's Tom Kennedy said. This has obvious implications for the balance of payment and is central to our view that the return to current account surplus in two quarter will prove temporary. It was a view echoed by ANZ's economics team. We think we have likely reached the peak in trade surpluses, ANZ's Hayden Dimes and David Plank said in a research note. We still anticipate strong surpluses from here, but expect their size to decline as key commodity prices like iron ore stabilize at lower levels, though still elevated levels. So that's where we're getting at $90 and not those $60 or the $45. Commodity prices on the slide. Australia produced its first current account surplus in 44 years in the June quarter, largely on the back of iron ore shipments out of Western Australia. 61%, I believe, of our exports to China come out of Western Australia. So that state is pretty dependent on the Chinese economy, you would imagine, at least from the export market. So it'll flow through. And we'll see what happens there. It's just something to keep in mind. Iron ore accounts for around 30% of Australia's exports by value. Well, maybe the data I have is out of date because it's saying here 20%. So it's quite. It may have gone up. That's even more concerning. Actually, it's even more concerning if it's 30%. Peaking at more than 126 a tonne in early July, while demand has also softened. Shipments of both lump and high-quality fines ores fell by 9% and 6% respectively over July. Coal exports also suffered a hefty 9% fall over the month. Coking coal volumes were down more than 20%, and prices were also weaker in line with falling Chinese steel mill demand and tougher import restrictions. So yes, here we go. The spot iron ore price. Well, there you go. From what is it? Why am I writing on a blue highlighter in there? So down to there. And we've just jumped up to about $90 again. A bit over at the moment. So, cool. Twin surpluses. Australia's shrinking budget deficit. Yes. Well, I'll get that in a second. The weaker July resource sector exports are likely to deteriorate further, with Reserve Bank's commodity price index slipping another 4% last month, driven down by further falls in iron ore and coal prices. IFM economist Alex Joyner said the turning tide on commodity exports had implications for the current account and budget surpluses, given both are largely underwritten by high iron ore prices. Well, what does that tell you about our economy, guys? Are we a banana republic that we're dependent on the whims of these foreign countries? And how many of our mining companies are owned by foreign corporations? I mean, well, I think I read yesterday 75% of the profits go overseas. The twin surpluses are a good thing and a hallmark of a healthy economy, Dr. Joyner said. While Australia will likely have twin surpluses, they are both heavily reliant on the same thing: iron ore prices. The fiscal budget surplus has been on track on the back of bracketed creep, but also a sharp rise in corporate taxes, and that has been driven by the miners and the rise in iron ore prices. Okay, so, I mean, our budget surplus for the entire country, for the government, is dependent on this one resource. Just think about that, guys. Just think about that. And while I'm doing that, I'm going to jump over here and let's have a look. Actually, we will jump back to the Observatory of Economic Complexity, and we can look at a product. So this is iron ore for Australia. Okay, so the iron ore trades. This tree map shows the share of countries that export iron ore. Australia exports 52% of the iron ore in the world. So the total is 93 billion. And then Brazil. So it's Australia and Brazil. I understand iron ore spiked because there was issues in, I think, flooding in Brazil that shut down a mine. Then the Ukraine. Oh, sorry. No, South Africa. South Africa, Canada, Ukraine, Sweden, India, Oman has some. Well, who else over here? Does New Zealand have some? Who else is in the... There we go, New Zealand. 115 million. They export some iron ore. Good on you. So who are the importers of iron ore? China, 63% of the world's iron ore. Then Japan. Other Asian, Germany. So if we go up here, you can see top exporters of iron ore: Australia, Brazil, South Africa, Canada, and Ukraine. Top importers: China, Japan, South Korea, Germany, and the Netherlands. Okay. So production complexity, negative 1.747. So out of all of the products in this database, it's 1,166th of 1232. Okay, so our country is exporting the most of iron ore in the world, a very low complex product, where the top exporter or top importer is China. Let's see, we can look at here the product connections. It's connecting to sulfate chemical. Okay. So yes, here we go. Profile for iron ore. I think I looked at that. Primary connections, iron reductions. So yeah, this is what we're looking at here. There's no more data. So there you go, guys. This is affecting the budget surplus. So when people are there going, yes, you know, I'm becoming more and more cynical about all this stuff that I hear from the politicians. You know, we're managing the budget surplus, we're doing really well. Is that due to their skill? Is that due to their maybe reduction in government services, or is it simply on the back of iron ore? There's no way that the government here in Australia, unless you're a conspiracy theorist, has a weather machine to control flooding in Brazil to reduce the global supply of iron ore, which will lift the price and then get our government in surplus. Maybe there we go. That could be the plot of a movie. That could be the plot of a movie. So that's where I'm cynical about all this stuff, guys. I'm becoming more and more cynical about it. What it tells me is exactly the same as running a business. And this is story time here. One of the challenges I would have, and I'll go to a full screen because I'm ranting. One of the challenges I would have as a small business person. I mean, we got up to 13 part-time staff, mix of full and part-time staff. That was the biggest we had. We ended up shrinking down about 5 and 3, as well as Rachel and I. But one of the challenges we would always have is that we would get a great client and there'd be a big client and they would just pump us full of work. And I'd be hitting points where 80% of our revenue could be coming from one client, particularly in the mining sector, in the mining boom back in 2011 when they were just, everyone was building these mines. We would have so much coming from one sector. I would barely have enough time to get out there and drum up other work. And what's the problem with that situation? That means you're completely dependent on that one client source. You're on that one revenue source. It means you've invested your infrastructure and your capacity to service that one client, so that, let's say you have a disagreement over a particular thing that you're not comfortable detailing as an architect, and you lose that client because it's design and construct, like I mentioned in other videos, and you can lose that revenue stream. That's very difficult to deal with. So, that's happened to me twice, where we've gotten so big and we've gotten so much work from one client source, and I would be out there working my ass off to bring in other streams, and it's really hard. It's really hard because often, if you're in bed with one big client, some people will go, no, you work only for them, you only do their work, you don't do us. We're completely different. So that was interesting. It was a situation I didn't like being in. It was a situation I didn't like being in. And it's where our nation is in. Our nation is like a small business dependent on a big business. Our nation is dependent on the iron ore whims of the world. That's what is driving our budget surplus. And for that, I'm having a stein, because that just sounds like BS. So, yeah. Whenever, if it's Labour or it's Liberal, whenever they say, we manage the economy better, we did a budget surplus, when you look at stuff like this, it just sounds like crap, doesn't it? It really does. Okay, they're going to give us a few more tax cuts and be a tiny bit friendlier to business, but, whoop-de-doo. Whoop-de-doo. Let's get it, I would honestly like to just go with let's give a libertarian government. Let's give that for 10 years and see what happens. Why not? What have we got to lose? So, back to the article, guys. Enough of my ranting. The federal government had put a suitable conservative price assumption of US $55 a ton. Certainly the prices have exceeded expectations and been the key driver in pushing the budget back into surplus. Well, okay. With the economy the way it is, with interest rates so very low, with the fact that our water infrastructure hasn't kept up with our population, should the government be going on a capital expenditure campaign? They already are. We've got a lot of capital expenditure happening around the country. Should we get more infrastructure? Should there be more planning? Should there be some investment rather than driving into a budget surplus? What do you think, guys? Let me know your suggestions in the comments. So, iron ore has been equally, if not more important, to the extraordinary improvement in the current account. Iron ore prices have skyrocketed. It's gone one way this year, and that has seen the trade balance improve to the extent it outweighs the income deficit on interest payments and profits we pay to the rest of the world, Dr. Joyner said. It's unlikely we'll see the current account surplus sustained for a substantial period of time because the iron ore price is so volatile and the concerns for the global outlook, which is not positive for iron ore. Yes, this is the problem. This is the problem here. It's just the global situation. There was some good news. Apparently, the US and China are going to look at more options for their trade deal. So then we saw, actually, let's have a look here, more so out of my interest. Let's see where our gold is going, because I noticed gold is down. Yes, 2.1%. Sorry, 2.2%. Silver is down 4.64%. So this is people taking profits from the, well, I'm assuming people taking profits from the spike in the precious metals, because there's now more confidence that there can be a resolution to the trade dispute between China and the US. But we'll see. We'll see. Hopefully it's not just another fraudulent tweet. So, as Dr. Joyner points out, slipping back into a deficit does not make the economy more vulnerable to global economic shocks. Oh, sorry, does make the economy more vulnerable to global economic shocks as the nation becomes more dependent on foreign borrowing to fund the deficit. Well, I buggered up that sentence, didn't I? That's another concern with the Australian dollar. If the dollar is heading the way it is, and where are we looking at now? Okay, the dollar is slightly up on today's trade. So it's 68 cents. Because if the dollar goes down, well, there you go. So guys, this is the Australian current account balance since the 1960s. And boom, we shot up. That seems completely natural and managed, not just dumb luck. What do you reckon, guys? Yeah, that's fine. This isn't cryptocurrency. Anyway, let me know what you think. What would your solution be? So here are the key points. Falling iron ore and coal exports in July point to Australia's trade surplus peaking at 8 billion. Prices and volumes have slipped further since as demand from Chinese steel mills has weakened. Falling commodity prices may mean the first current account surplus in 44 years is just a fleeting affair. What's more concerning to me is how dependent our nation, our civilization is on one resource. Let me know what you think in the comments, guys. Like, share, and subscribe, and I'll see you all later. Take care.